A few weeks back, a SPAC by the name of Digital World Acquisition Corporation, DWAC, burst onto the scene by announcing a definitive merger agreement with Trump Media and Technology Group, and the SPAC's price went crazy. I'm Seth Froyberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the traders on our desk traded DWAC very actively, but since the end of October, the stock is more or less flatlined. In today's video, we're going to cover a strategy that can work out brilliantly in just such a circumstance where a high volatility stock goes quiet for a short period of time. So if that sounds like it's of interest to you, then stick around because I think you're going to find this eye-opening. Hi, I'm Seth Froyberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so DWAC has become a very popular trading stock since it was announced last month that this SPAC had teamed up with former President Trump as part of a business venture focused on launching a social media platform that many believe will become wildly popular. And so it's no surprise when this stock skyrockets in value, rallying from single digits to as high as 175 at one point before pulling back into a tight range. And so when a stock with that kind of extreme price movement goes into a quiet period, options traders have strategies in their playbook to take advantage of those times for quick, high-profit trading opportunities, and that's what we're going to be covering in today's video. Now, before we get into the details of exactly how this strategy worked, I wanted to let you know that if you want to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause the video, sign up now, and then resume watching. The example that we'll be teaching you involving this quick 3-day option strategy uses call options on stocks to take advantage of the situation. So to make sure that everyone understands how these work, we're going to do a super quick review of call options. If you already know how they work, then just hang in there. This is going to be quick. Okay, so a call option on a stock entitles the buyer of that option to buy 100 shares of a stock at a certain price called the strike price of that call option, regardless of what price the stock is actually trading at when he exercises that right. The buyer of the call option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go way above the strike price of that call option, in which case the buyer can exercise his option and force the call seller to sell his shares at the call option's strike price, which is lower than where the market's trading, causing the seller's account to get marked down. So even if the market goes way above the strike price of the call option, the buyer of that call option has the right to buy 100 shares of that stock at the strike price of the call option, and he can turn around and sell those shares at a much higher market price 1 second later for a big profit, theoretically. And so the premium of the call option reflects the risk that the market thinks the call seller has of the shares going much higher than the strike price of that call. So all other things being equal, when a stock price goes up, the price of a call option for that stock will go up because the call seller's chances of taking a loss because the market has blown through his strike price gets larger as the stock price rallies. But when the stock's price goes down, the call option loses value. And if the option expires and the stock's price is below the strike price of the call, then that call expires with no value at all and the call buyer loses. Okay, so with that as background, let's move to November 2nd, after the stock had started to settle into that tight range between 55 and 69, on this day trading at around 60. And so let's say that we decided to go ahead and sell 10 of the DWAC calls expiring 4 days later and buy 10 calls expiring a week later, but at that same 60 strike price. Well, when we do that, that combination of selling a call closer in time and buying a call at the same strike farther out in time, that combination is what is known as a call calendar spread to options traders. So drilling down on this transaction, what's going on with the cash flow is that you're buying those 60 calls expiring in 11 days, and you're paying $6.95 for those. But remember, each options contract represents 100 shares of DWAC stock. So you multiply that by 100 and you're buying 10 of those. So the cost of those alone is $6,900, but you're simultaneously selling 10 of the 60 strike calls expiring a week earlier for $4.95. So you'll pay a total of $49.50 for those, leaving you with a net cost of $2,500, which is your risk in the trade. Now, you may be wondering, why would we structure the trade in this way? And the answer will become more obvious to you if we move to the final trading day of the calls we sold, which was Friday of that week. And as you can see, the stock generally stayed in that much tighter range of 54 to 69. And by the time Friday rolled around, the stock had actually sold off to 58.78, a few points lower than it was selling for the day we initiated the trade. So first thing in the morning, let's analyze where the trade stands. And as you can see, the calls that are expiring that day, the calls that we sold, those are now trading for just 98 cents, even though we had sold them for $4.45. Why? Because they are expiring at the end of this day, and the stock had dropped to 58.78. And by the end of the day, if the stock doesn't get back over 60, those options become completely worthless. And as we discussed before, no one is going to exercise a call to buy the stock for 60 if it's trading for less than that in the open market. And so therefore, they're losing value very quickly and have dropped to 98 cents as the chances of the stock closing above 60 by the end of the day get smaller by the minute, while the 10 options we bought expiring at the end of that next week, those had dropped to a price of $4.65, down from $6.95, which also makes sense because the stock's dropped in value. But this is a volatile stock, and the stock could easily get back over 60 before the end of the next week. And so those calls still have a meaningful value. And even though the stock has dropped, and this point is crucial, because there's so much time left, another full week, they don't lose their value nearly as dramatically as the ones that are going to be expiring by the end of the day. So now let's look at what the outcome of the trade would be if we decided to close it at this point. And so to close the trade down, we need to take two steps. And the first step is to sell the 10 calls we bought earlier in the week when the trade began. And for those, we receive $4,650, as you can see, using the same kinds of calculations on those 10 options as we discussed before. But we also have to buy back those calls we sold, which are expiring at the end of the day. And as you can see, doing so cost us $980. And then remember, we originally spent $2,500 to enter the trade. So subtracting that out, we arrive at a final profit figure of $1,170, a return of over 46% against the original trade cost of $2,500. And the reason this return was so extraordinary is explained by the very nature of calendar spreads. The key to understanding why a calendar spread works is to understand that selling an option at the same strike as an option you'll buy in a later expiration period gives you the unique edge of the fact that in a flat market, the options we sold, which expire earliest, will lose their value much faster than the ones we bought, which expire later, as you saw in this example. And it's that relative difference in the price of the two options that creates the profit, as you can see in this case, where the short options lost $3.47 in value, while the long options only lost $2.30. And so the ones we're short lost more than the ones we're long, which is obviously exactly what you want to happen. It's this relative difference in what options traders call time decay between the front week options and the back week options that makes a calendar spread work. We're selling the options that are expiring earlier and decay quicker, and we're buying the options which expire later and decay slower. And so what I'd like you to take away from today's video is the fact that even volatile stocks go into periods of relative quiet, and there are quick, high potential trade opportunities that exist that are specifically designed to exploit those conditions. In this case, we took advantage of a stock that had settled down, and then, because of our knowledge of options trading, we were able to construct a trade that made a remarkable return in just a few days. That's the kind of tool that professional options traders have in their toolkit, and it's important that you develop these tools as well to profit from this very common situation with volatile stocks that go into periods of relative calm. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it. And please don't forget to hit our subscribe button right now so that you don't miss any of our free trading videos that we post constantly to help you to improve your game as an options trader.